Hi, I'm Jimmy. In this video, we're going to look at the Great Recession. Was it possible for everyday investors to see the trouble ahead before it happened? Because if we could do that, well, imagine the money that we could have saved, or even the money we could have made, sort of Big Short style. So each month on this channel, we do an analysis of the US economy, where we go through a handful of economic indicators to see if we think we should invest now or wait for the stock market to crash. This is what our scorecard looks like from the most recent video. And clearly we marked this one as neutral. We got 3 points for the bulls, 3 points for the bears, and then we got one neutral group. That's what we call it when we have both in the middle there. Now, I got some pushback on using the S&P 500 as an indicator, since we're not really trying to predict where the movement of the economy. Ultimately, we're after predicting the movement of the S&P itself. So let's cross that one off the list. Okay, so what we're going to do in this video is we're going to perform this exact same analysis. This is what we do each month. But this time, we're going to try to perform this analysis as if today were right before the stock market crashed in 2007. This is what the S&P 500 had done leading up to the Great Recession. And I know we're thinking this looks very similar to today, but either way, our analysis is going to happen as of right here. This is the very peak of the stock market. If we had done this analysis at that point, well, what would our results have looked like, being as objective as we could possibly be? Okay, so let's go through each of these items on the scorecard fairly efficiently and fairly quickly. First up, we're going to look at the yield curve. So this is a chart of the difference between the 10-year Treasury and the 2-year Treasury. So here's basically what we're looking for. Clearly, the 10-year Treasury should pay a higher yield than the 2-year Treasury does. So at this level here, well, the 10-year Treasury was actually paying 1% more than the 2-year Treasury would have been. We expect this number to be positive. Well, when the yield curve inverts, which they call an inverted yield curve, well, that's when this spread goes below zero, which means that the 2-year was actually paying a higher interest rate than the 10-year Treasury was. This happened a few times back here. Now, this is crucial because every recession that the US economy has gone through has been preceded by this inversion of the yield curve. Now, interestingly, at this point in time, well, the yield curve is positive, so we actually have a very similar situation today, that the yield curve is no longer inverted, but it was inverted a few months ago in that this spread was negative a few months ago. So where do we mark this on our scorecard? Well, in the last video, I actually gave this as a neutral point because it's no longer inverted. And some people pointed out that because the yield curve was inverted a few months ago, this should be a negative point. But for the sake of trying to be as objective as possible, since I did it just last month, I'm going to stick with this being a neutral point, although you feel free to adjust this in your own analysis and call this a negative one if you'd like. So for now, we have one neutral point for the economy right at the peak of right before the Great Recession. Okay, next up we have manufacturing. Now, once again, manufacturing in 2020 is negative. We marked it as a negative point. But when we look at the ISM manufacturing indicator back in 2007, well, clearly we can see that this is trending lower, which is a negative thing for the economy. If the economy was getting stronger, we would expect for this to be at least steady, if not moving higher. So this looks like this is clearly going to be a point for the bears. Now, the key level on this particular indicator is 50. Anything above 50 implies growth, albeit in this case, slower growth. Compare that to back here when it was below 50. Well, that was actually negative growth. So that's worse. Now, that was coming out of the tech bubble crash. So best case scenario, we can call this a neutral point because it's above 50. But because this is actually trending lower, I think that this is a potential problem for the economy at this point in time. So I think we have to give the point to the bears. Okay, so on our scorecard, we're showing one negative point and one neutral point. Next up, for our indicators, we have an indicator that tracks the percentage of car loans where people are 90 days or more late on their car payments. And the fact that this chart is moving higher right now is certainly a negative thing for the overall economy. Now, this chart actually covers one of the shorter time periods of all the charts that I have, because that's as much data as I could find. I couldn't find anything going back further than that. But either way, this point stands for the bears, since this is a negative thing for the overall economy. So jumping back to our scorecard, we can give another point to the bears over here. Okay, next up, we have consumer confidence. In modern times, consumer confidence is actually a positive thing for the economy. This is where the consumer confidence is today in 2020. But if we eliminate that, well, to me, consumer confidence seems to be somewhat of a negative thing. It seems like consumer confidence is falling leading up to this particular point in time. But on the flip side, we could also, maybe we want to say it's not as bad as it was back then, so maybe it's trending higher. Sure, it broke that trend line right here. But if we were looking at this chart today, I would say that I'm concerned about the confidence of the consumer as of this point in time. But I would probably end up giving this one a neutral point. So with the goal of being as objective as possible, I think on the scorecard, it makes sense to go ahead and give this a point in the neutral column. But I am curious how you would mark this one up, or even the yield curve. Would you have gone with the neutral point on the yield curve, or on this particular indicator, or would you have gone a negative point? I doubt we would have gone positive, but I guess, hey, anything's possible. Please let me know what you would have done in the comments below. Okay, next up, we have CEO confidence. And when we look at this chart, well, clearly, this is a negative point. This is a point for the bears. This is a negative thing. To me, it's quite clear that this is trending lower, and this is actually a really easy one. So, jumping back to the scorecard, well, once again, this is a point for the bears. So right now, it seems that our scorecard is leaning towards the bears, which is likely a bad sign for the stock market going forward. Okay, now we're going to look at our housing indicator. Now, housing starts is how many new homes are being built in a given period of time. And given that the Great Recession was preceded by a housing boom, so the time period we've been analyzing is in theory at the very peak of a housing boom, I was actually quite curious to see how this indicator looked at the peak of the stock market before the Great Recession. So this is what housing stocks would have looked like in October of 2007. Well, clearly, this is negative, and this is going to be a point for the bears. And much to my surprise, housing starts had peaked more than a year before this particular analysis, and it was getting rapidly worse. So if we were paying attention back in October when we're doing this analysis, well, at this point, the stock market was at its peak. Well, it may have been obvious that things were in trouble. Now, you may notice that on each of the charts, it said September. And that's because I'm assuming that we're analyzing this in October, and the October's numbers haven't been published yet. So we would have had September either on a monthly basis or quarterly basis, depending on what the indicator does. That's why each of these say September, but we're actually looking at it as if we were in October. So when we go back to our scorecard, well, we can see that clearly there were troubling signs ahead for the economy. And since the stock market tends to lead the economy, well, it wouldn't have taken a rocket scientist at this point to at least guess that there was trouble ahead for the stock market. And if we're curious, this is what the S&P 500 actually did by the end of 2008, and clearly it wasn't a good thing. Now, I know that I mentioned that this video is designed to look at the effectiveness of our monthly Invest Now or Wait series. Well, we do this very same analysis each month, and we're trying to objectively gauge where the economy could be going and where the stock market could be going. So if you're curious, well, that series could be a good next video to watch. It might make sense to keep up with that if you are investing or if you're considering investing. And I want to thank you so much for sticking with me all the way into the video. I really appreciate it. I hope you found this interesting. Thanks, and I'll see you in the next video.